future. We're talking real money.
Well, it's another Saturday as we gather together around the communal radio and microphone to spend a little time trying to do something important, and that is make money easier to deal with. Because money is really important to all of us. It's something we all use all the time. We have a job, most of us, to earn it. We spend it. We hope to save it and invest it and then live off of it in retirement and do some nice things along the way. And we want to help you do all those things that you do. Now, the part you're really good at, we're not going to help you much with that. You're really, really good at the spending part. Congratulations. You're reasonably good at the job part, most of you. Congrats. The saving, investing, ooh, putting enough away for retirement. No, the numbers don't speak well for you. So that's the area where we have to spend a lot of our time. And the biggest reason, well, first let me give you a phone number because you may need to call us because we know you need help. 855-935-TALK is our number, 855-935-8255. One of the reasons you have such a hard time with the investing part is you believe that events themselves impact investments after the fact, that investments move in reaction to events. And nothing could be farther from the truth. I'm Don McDonald, Tom Cox over there, and the event we're talking about this year is presidential elections. We all think they're more important than they really are, Tom.
Well, when it comes to your investments, they may be very important when it comes to your politics.
I'm going to question that one, too. Can we just call this one off? Just kind of wait. Just wait for a little while. We're going to have a couple of old guys both croak soon. And when they're gone, then we can start over with young people again.
What's young?
Under 70.
We're really getting down
Under
there,
70.
Huh? Okay.
Our age. We're the young
crazy.
Punks. Yeah.
The young punks on the up. Yeah, okay. Yeah, it is fascinating. And this comes from a survey done by Janus Henderson Investors of 1,000 people. And they asked people, what is stressing you out? What are you concerned about over the next 12 months? Now, some people said rising interest rates, risk of recession, persistent inflation. Those you could kind of see, right?
Those happen, but those are ongoing.
Yeah, people think it's just right now. No, you're always kind of thinking about those things. They're always there. They might not always be in the headlines, but they're always there. But the one that always surprises me is this one. And it's already out there. You're hearing about it today. 78% of the people they polled are either very concerned or somewhat concerned about the 2024 U.S. presidential election. 8 out of 10 of us are worried about this and what it will mean to our investments and what it will mean, really at the end of the day to what kind of returns and people respond to this stuff. We're going to give you a couple people that I think just gave some people in the business that gave out idiotic suggestions. And I think it's because they're promoters, again, like, hey, listen to me, wave them a flag over here. But if you're one of those 8 out of 10, and imagine some of you are out there, can we just give you one word right now?
You're wrong.
Relax.
Oh, that's 2 words.
Relax.
You told me that people do not respond well to being told to relax.
My mom used to tell me never tell somebody that because they'll tune out right.
Another momism.
I know. Yeah, never tell somebody. Relax.
My concern isn't about the elections. My concern is about being unable to talk about the elections. Honestly, it feels like for the first time ever.
Mean next November?
To be able to talk about them in advance, to be able to talk about the election itself. I remember in the old days, I used to be able to do that. You were able to discuss the election without people hating you.
Yeah, without the tomatoes and rotten eggs.
No, death threats and things. Not even that. There's that. I mean, my gosh. Anyway, but there's no reason for investors to be concerned about the election. No,
there isn't. The numbers bear out the fact that, okay, we'll talk about your fears because you do fear things more than you get excited about the upside. We'll talk about Daniel Kahneman in a few minutes. But the thing is, 83% of the years, and I know, okay, that means 17% aren't, but 83% of the years in presidential election years, guess what? the market goes up.
Yep.
Kind of like they do in every other.
Yeah, exactly. That's because the markets go up 75% of the time, 75% of the year. So they're likely to go up in an election year, and it doesn't matter who gets elected, which party. 855-935-TALK.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
This program, this radio show, this podcast is designed to both be educational and interactive. That is why we invite you to call us during the show at 855-935-TALK to talk about your money concerns, worries, questions, concerns, confusion, all that kind of stuff. And we've got someone who just called in, and that is Calvin. And Calvin, you're on. Welcome to Talking Real Money.
No, thank you. So I turned 66 this week.
Happy birthday.
I have thank you. I have a 401k with Fidelity, and then we have Roth and traditional Roth also at T. Rowe Price. And together, my wife and I have about $670,000, I guess. Just wondering if it's time to not be so aggressive in the market, I guess. And also, I've been getting a pitch from Fisher Investments.
Yeah, I bet you have.
Those are two different things.
Yeah, way too.
So.
As a matter of fact, Fisher Investments will likely be more aggressive than what you're doing, but I don't know what you're doing. What are you invested in with Fidelity and T. Rowe Price?
Well, mutual funds. Everything are mutual funds.
Okay, but what kind of funds? That doesn't mean anything to us because you got stock mutual funds, you got bond mutual funds, you got real estate mutual funds, you got gold, all those things. Like what? Give us, break it down a little more for us, if you would.
Okay, with Fidelity, I'm in their 500 fund, their growth fund, their OTC fund, a low-priced fund, their balanced fund, and some in federal or Freedom 25.
Okay. How about with T. Rowe?
And with T. Rowe, I have communication and technology, global growth stock fund, health sciences, spectrum income, and then I match that in both my traditional and Roth at
You've been
T. Rowe Price.
You've been working too hard. You've been picking too much.
Is that right?
Yeah, this is a classic hodgepodge. Classic case of hodgepodgeitis.
That's what I was thinking.
Yeah. You could simplify this with like 2 or 3 funds and just be done with it. I mean, you could do. I mean, think about this for a second. You're 66. Have you sat down and determined what you want this money to do for you in the future? What you need it to do? How much money you need this money to make for you? Have you done that yet?
Yeah.
You have?
A little bit.
There's no little bit here, Calvin. I'm going to interrupt you. I mean, you really need to know the rate of return you're trying to achieve on the money. That's the first thing, because that then allows you to build the correct, I hate this term, asset allocation, the right balance between riskier things like stocks and less risky things like bonds. It doesn't sound like you got a lot of bonds to me, because all those first ones you read off were all stock funds. You got the Freedom 2025. Yeah. And so that does sound, because your first words were, am I being too aggressive? It sounds like you very well may be, but I don't know that, because if you say, look, I need to make 8% a year on my money, well, then you need to be more aggressive. If you told me I only need to make 4%, then you could be less aggressive. But that's the starting part of anybody who invests. By the way, that's true of 1888. You got to know as Don said, what you're trying to do with the money. That is at the core of it, because after that, you can clean up the hodgepodge. Don's right. You could have far fewer funds, and we don't think you should hire Fisher. We could go into that if you want a little bit more, but
he's a stock picker. Yeah,
he is a picker, and the only track record you can really see of his is a mutual fund he ran for a period of time that underperformed the indexes. So not very helpful for him to say, here's how great I've done, when nobody can really measure that performance. So here's what I would do at 66. And by the way, congratulations being 60. According to Don, you're now eligible for the next generation of leadership in the country. Which is
you can be president now.
You can be president.
I heard that, but I cannot. I was born out of the country. Sorry.
Darn it.
Okay, but these days, who really follows the rules anyway?
Yeah, what rules? We got no rules.
Doesn't really matter. So you need, but what he really needs is to at least talk to somebody first and advise. 100% fee only fiduciary. Put together the plan. Then, if you wanted to say, "Look, I'll go manage it on my own," at least you have a starting point.
Yeah, and if you want to talk to Fisher, but just don't go with them without checking with some other people first, because one, they do buy individual stocks, so they're acting like a money manager. Yeah. They're acting like a mutual fund manager, which we don't think anybody can do anywhere. And you've got a lot of actively managed funds in your portfolio, and we don't like those either. But again, here are the basics. You need to understand your risk tolerance. That's critical. But before you do that, you need to understand your risk need, as Tom said. If you don't need any more than 3 or 4% off your portfolio, why be more risky? Why? Just to win the money lottery? You've lost. I guarantee you've already lost. So you need to know your risk need, then your risk tolerance. Then you could even without going to an advisor, you could create a portfolio using something as simple as the Vanguard Total Stock Index and the Vanguard Total Bond Index in the correct proportion. Your portfolio could be that simple, and I believe it would be far better than what you have today.
And I'll make one more suggestion to that. I would have one custodian. I talked to a nice couple yesterday. They had 5 different custodians. It just gets to be too confusing in retirement.
Too much work.
To try where I got this, there, it's no. Because at one custodian, you could buy anything you like anyway in today's world.
Yeah. Yes, that was something that I was wondering about too. I thought,
pick one.
Consolidate it all. No, not T. Rowe. Consolidate it all at Fidelity.
Fidelity's a very quality place.
But then start working your way out of all those funds. You don't have a tax problem to deal with because there will be no taxable event. Start working your way out of all of those funds. And if you do want to do it on your own, work toward a portfolio that is 2 or 3 or 4 really good, broadly diversified, unmanaged, exchange traded funds.
Cheap.
Go cheap.
Save your money. Yep.
All right, sir?
So can I do ETFs within my 401k?
Absolutely.
No.
Yeah.
Not in this 401k.
Oh, no, not necessarily. Yeah, you can only do Fidelity index funds in your 401k.
But if you retire, you can move that money to an IRA, and then you can use exchange.
When are you going to retire?
I think in 2 years.
Okay, so you go with Fidelity index funds for now. You can use a Fidelity Total Market and a Total International, and then the Fidelity Total Bond Fund. Just those 3 in your 401. So that's the way I'd go.
I appreciate it.
All right, Calvin.
I appreciate your time.
Thank you for the call, sir. You take care. 855-935-TALK is our phone number here, 855-935-8255. And AJ, you're next. Welcome to the show.
Thank you very much. I'm calling back because I spoke with you a few weeks ago, and you did give me some advice, but now I need some additional advice to the advice you gave me.
Okay.
And I have to make one comment, and this has nothing to do with money. It has to do with if women ran the world, we would be a much better place.
I'll give it to you guys.
Okay.
Like actually, right now at this, where we've got the us guys that got you, that's not hard.
AJ, will you take the gig?
Low.
I'll give it to you right now. If I had that power.
So, yeah. Well, anyway. When I spoke with you last time, I had mentioned about having all these individual bonds, and you recommended putting them into. I was hoping that wanted to put them into a mutual fund, a bond mutual fund. Now, this is my question. When they do mature, should say it's $30,000, the bond worth $30,000.
Hold on, I'm going to need to interrupt you because we have to go to a break, and we'll finish the question afterward. Be right back.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Hey, welcome back. I'm Don. Tom's over there. 855-935-TALK is our phone number, and that's how AJ got in touch with us. And AJ called us before. She has a lot of bonds in her portfolio and is trying to simplify the management thereof. And your question is, when those bonds mature... Fill in the blank.
Should I put all the money immediately into the bond mutual fund, or
Yes.
should I, do it as staggering, like
Nope.
every month?
Buy it.
All at once. All at once. Because it's a lateral move. You're moving from
Right.
a bond into bonds. So it's a lateral move.
Okay.
You don't want it, because if you do it slowly, now you're market timing.
You're betting on what the future is going to look like, and nobody knows that.
So that's true. I understand that. So I was hoping that was what you would recommend, because I didn't want to have to deal with,
No.
gradual.
It's so much easier.
I got to get it all in. So.
Yeah, we are big
Okay,
fans
thank
of
you so
keeping
much,
it simple.
guys.
Thanks, AJ.
Yeah.
Just
Unfortunately, I didn't learn that until late in life.
it doesn't really matter. You learned it.
Yeah,
I mean,
exactly.
and
I
thank you
didn't
for the
either.
call. And we do want to remind people that like stocks, you want to be diversified in bonds. A bond fund holds, geez, what did we just look up? Vanguard total bonds, like
15,000 bonds. Yeah.
You just get diversification. So if something goes wrong with one of them, then
Who
that
cares?
doesn't really matter, because you got a lot more. So
You got
that's why we like
14,999
Yeah.
more. So try singing that song. 15,000 bonds on the wall. If one of those bonds should happen to go bankrupt, 14,999 bonds on the wall.
I was going to say take a fall, because that kind of.
That rhymes. 855-935-TALK. Larry, it's your turn. Welcome to the show.
How you doing, guys?
Good, Larry. What's up?
Hey, good. Hey, I just retired, and I'll be turning 57 this July. Me and my wife have over $1 million in our 401k, and like another 30,000 in IRA funds. And we just got news that her daughter is going to be having twins, and she's out in Utah, and we're in the Midwest. So we'd like to be traveling out there a little bit more. What is the best way? First of all, should I leave the money in my 401k plan with my work because I'm under 59 and a half, or should I move it out? And then how do I take money out of that? We'd like to take out about $200,000 to $250,000 to do I got my house is paid off. I have no bills. And I'd like to take some money out to buy a camper and a decent truck and do a couple house projects. What is the best way to do this?
Okay, first.
Wow.
First.
Wait, one last thing.
I got about
Don't just buy a junky old trailer. Get yourself an Airstream.
I know where you could get one cheap.
That's what we're looking at. I've been listening to you.
But let me give you a little. Let me give you a little Airstream advice, because I've discovered now what a great idea this. A new Airstream is going to cost you $110,000 to $140,000, roughly. You buy a used one, you get it inspected, make sure it has good bones, and then you take it to one of these places that does refurbishment, not remodeling, but they clean it up. The most you're going to spend on that is probably $50,000 or $60,000. So you could have a $100,000 Airstream for like $50,000 or $60,000.
I hate to break in on trailer talk here.
Trailer
this is supposed
talk.
to be about money, if you don't mind. Okay.
Just saying.
First of all, Larry, and congratulations on early retirement. You're not even old enough to be in leadership in this country, because I think Don limited it to people.
No,
after
I said people under 70. I said under 70.
There's a minimum age. But that's a lot of money to take out of $1 million. So here's a couple questions for you. Number one, have you done any planning about this? Have you sat down and kind of looked at the numbers?
Spoil sport, kill
I'm
joy.
Be the bad bunny today here on the Easter weekend. So, I mean, that would be part one for me. I would want to run that very carefully, because retiring at 57, do you have any other sources of income other than taking money out of this individual retirement account?
I do get over $4,000 every month for a pension.
Wow.
So you have a pension of $50,000. Okay.
Wow.
And what's going to be your
it's
cost of
about
living
60,
in retirement?
Yeah, what have you done the calculations?
Actually, I don't spend more than I make. We don't spend that much money.
Okay. Hang on with us a
Like
minute.
that everything's paid off.
You know, the news, when we're doing the live show, the news always sneaks in and takes precedence over you. I'd rather just keep you straight through, but they say we have to go. We'll be right back with you, though, Larry. Don't go away.
Tom and Don are talking real money. Money Radio for a really great future. We're talking real money.
If you ever deal with money in your life, then you need this show. This radio show on Saturdays or this podcast every weekday. And you can call us on the Saturday show at 855-935-TALK, 855-935-8255, just like Larry did. And we're talking to Larry. Larry's got about $1 million. He retired early. He's got $1 million in the 401k, a little bit of money in an IRA. Is that all the monies you have, Larry?
Yes. Paid off house. Our house is probably worth about $250,000-300,000.
Okay. And you now want to get some sort of a means by which to travel back and forth to Utah to visit the grandkids.
Yeah.
Yeah.
He said he wanted to pull $250,000 out of his retirement account. Did I have that number right?
Yeah.
2 to 250, and that would be to do a couple of home projects too. But one little thing, I've got 125 of that in the Roth and over 950 in the traditional.
Okay. That's helpful.
That makes a difference.
It does make a big difference, because if you just pull 250 out, that makes me nervous in terms not just the balance, but also the taxes.
Yeah.
You're going to pay, 30%. I mean, it's going to be, I always forget the tax rates, but it's going to be pretty high at that.
They pull out 20%.
Well, I mean, yeah, you'd be in the 24% bracket. I mean, so that would be pretty hefty. I'd hate to see that. So, I mean, and here's the other thing I kind of thought about, but borrowing money now is not cheap. I mean, if this was a few years ago, I might be tempted to say, get a mortgage or something and take it out at 2.5% or 3%. But now you're going to be looking at, 6.5? Yeah, 7, whatever it is.
7, yeah.
Yeah, so that's not ideal. So here's probably what I would do. Part one is I would try to pull the money out bridge it over a couple of years. In other words, do some in 20, if you can, 20 or 24 and some
to reduce the tax hit, to keep your bracket creep down to a dull
And then
roar.
number two, try to balance it between the pre-tax, the traditional, and the post-tax like Roth. Again, so the taxation is a bit lower. Because it sounds like I was also very worried when you said you're going to take basically 25% of your money out and do this. But now that we know the pension supplies most of the income you need, and at some point you'll be eligible to file for Social Security, et cetera, that will help make up the difference. So I'm not as worried about that.
And my advice then becomes even more important, because you won't have to take out as much if you get the used Airstream and a used tow vehicle.
Thank you for joining us for Trailer Talk today. So, yeah, we never miss it.
Are you handy? Are you handy? Are you handy?
Yeah.
Hey,
yes,
you can do some of the work yourself. There's all kinds of guides online. You just
actually maybe you could do some of the work on Don's.
Yeah, I can bring it through Utah. Actually, we're coming back. We're going through you. Oh no, he's in Illinois. You're in Illinois, right? Yeah, you're.
That's
in Illinois.
not going to happen.
Yeah. All right.
That's all right.
Sorry.
Thanks, Larry.
Gotcha. Thanks, guys.
All right,
Good
sir.
luck
We'll wish you well. 855-935-TALK. Dave, you're next. Welcome to the program.
Hey, guys.
Hey, Dave.
Well, long-time listener, pick your brains often, but I think I might have gotten ahead of the game. My stepson came back from his years in the Navy and had some funds sitting in a bunch, he had some cash sitting in a bunch of individual stocks. And I said, come on now, you can do better than this. Let's get diversified. Let's drop that into a Roth. You're young, let it grow, so on and so forth. He's using his veterans benefits going to school, and lo and behold, end of the year, we're working on his taxes. He didn't have enough income, W-2 income, to contribute to the Roth. So not only did he contribute maximum to the Roth for 23, being ahead of the game, he's already done that for 24. And I need some ideas on how to get that out without getting hit with either the 10% penalty or the 6% penalty for leaving it in.
I have a question. He has zero earned income?
Yes.
Oh, okay then.
Okay. So, yeah, then he cannot make a Roth contribution. So he had zero income in 2023 as well?
2023, and unless he
changes,
picked up for this internship, he's not going to have any for 24.
Got it. Yes, he can't even move that to an IRA, right?
No, you got to have earned income for that too.
Yeah. So you can't. Yeah, that's a problem. Yes,
Yeah.
that money's going to have to come out, and yes, there's going to be a penalty involved,
Yeah.
and it's going to be a tad unpleasant. But
the sooner you do it, the better off you are, because there's a 6% excise tax for every year it remains in the Roth.
oh, is that what it is?
Yeah.
Oh, God.
So
I mean, you could
now
you could go online and type it in and figure it out. It's not going to be
the
complicated.
2024. You said there's a chance of him having earnings this year, right? I just unwind the 23 right now and bite the bullet and pay it sooner than later, because it just keeps growing if you don't. So get it done. You got to pay him. There's no trick that I am aware of. If somebody's aware of a trick, we'd love to hear it, but I don't know of one. Thanks for the call. 855-935-TALK. Call us.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
And lucky for us and lucky for you, the calls just keep rolling in to 855-935-8255, which spells talk on those little letters on the keyboard there on the phone pad. We still have phone pads on our phones. We do. I've seen them. Yeah, we do.
You're going to laugh today. I was doing a little spring cleaning. Guess what kind of phone I found?
A dial phone?
No, not that old.
Oh, just a
BlackBerry.
BlackBerry. Oh,
I hope it's worth something.
Oh,
it's
not. It's
okay.
not.
I was hoping.
It's
maybe in Canada it would be or something.
Not even there.
Their one thing. No, okay.
Not even there. Ladies and gentlemen, welcome to BlackBerry Live. Yeah, I remember those days.
Exactly.
I was the voice of those conventions. Jim Balsillie, and it was Balsillie at the time, not Balsley.
They changed it for the show.
They did. Anyway, moving along, our next caller is, well, Chris. Chris, welcome to our program.
Hello.
Hey, Chris, what's up?
Hello.
Hello.
My parents died about 2 years ago, and I really don't have any financial background. I've usually been living paycheck to paycheck, and I have about $800,000 in inherited IRAs, and I'm not really sure. Is there some sort of calculator or something that would help me with being able to pull that out? I've been told I have to remove it over a 7-year period.
Well, you've been told wrong. You have 10 years to take it out of an inherited IRA. A non-spousal. This is from your parents,
yeah,
correct?
So it's non-spousal. Right? Yeah, so it's a 10-year. It's a 10-year term. Yeah.
Yeah. So and you could take it all out in the 10th year if you wanted.
Right. There's no time frame.
I think it was in a trust. My brother was the executor, and so he dealt with it for the first 3 years, and just recently transferred everything into my name. And so that's why I'm thinking I'm taking the 7 years from.
Yeah, so that would 7 plus 3 does
right.
equal
So
10.
7. You have 7 left.
Correct.
7 left.
But there's no calculator because you can take that when you want according to your tax situation. Let me ask you. So, do you have regular income today? Are you employed?
Yes, I'm employed. I make about $75,000 a year.
Okay.
And is that likely to change in the next 7 years?
It could, depending on how much I'm having to pull out for the IRAs. I'm 65 recently this year, and I'm hitting 20 years with my employer, and so I'm considering retiring in the next 2 or 3 years.
So here's what I would do under that circumstance. I would take out only some each year, maybe up to the next tax bracket, because it's 75.
Yeah, let me go back. Let me go back a minute.
Yeah.
Let me just go back
in the
though
12%
a little.
bracket. Yeah.
Where is this money now?
It's in a couple accounts in Fidelity and a couple accounts in Vanguard.
And who is helping you? Are you managing them on your own, or do you have help?
I've just been given them. My brother said he'd help me if I needed
Okay,
it, but
good.
He's not in finance.
Okay, well, because one of the things we talk about this a lot. We're big believers in people being able to manage their own portfolios. It's not that hard until you get to this point in life. That's when it becomes complicated. When you've got withdrawals you've got to make, when you've got tax planning you need to do, when you've got income streams you need to create. I really think, and I think this will be a huge help to you, If you find a true, I love that you have Fidelity and Vanguard. You could even go to them and get a fee, ask for a fee-only financial advisor, someone to help you there. Or locally, find your own fee-only, well, it doesn't even have to be locally. Find a true 100% fiduciary fee-only advisor. And if you want help doing that, just go to talkingrealmoney.com/help, and we've got all kinds of resources to help you find one. But you're to that point where you really need that to manage the tax situation and to create that income plan for the future.
And to have the right portfolio moving forward, because this money could be very helpful to your retirement, handled properly, invested properly.
You could be comfortable for the rest of your life.
Yeah, and so what I was saying around that is that you're in a low tax bracket today. You want to kind of stay in that tax bracket, and if it looks like you're going to retire along the way, then that would be the time to pull the money out, right? Because your taxes would actually be a little bit less. But Don's right. Professional help at this point probably makes very good sense.
Yeah, and as you get closer, as you get past retirement, that's when you start accelerating the withdrawals. But again, tax planning is critical because you want to hold back as much as you can until the last couple of years, because if you take it out, you lose the opportunity to make money on the money you're going to have to give to the government. So there's a balance, and this is why it gets so complicated. There's a balance between keeping your tax bracket reasonable and losing the earning power of that money. So this is where life gets fiscally tricky. In nearing retirement. It really does. I think that's why so many older people have advisors. I really do.
All right. Thank you very much.
All right, sir. Thanks for the call.
Thanks,
we
Chris.
wish you well.
If Congress would do what I suggested, other than fixing the AM radio debacle. Thank you, Congress, for that. If they would move everything to Roth, this would not be an issue.
I know. I think actually
cleans it up.
It makes it so much simpler.
Right. But the people Chris got to figure all this out.
The people who take the big deductions are going to complain, like everybody complains.
Everybody's going to complain.
Everybody complains about everything all the time. I'm telling you, I'm now the president of my HOA board. What idiocy? What idiocy was that? You asked.
Dumb.
Yeah,
really dumb.
I mean, I already served 5 years on that board years ago, and then 8 years on another board. Now I'm back on it. And the other day, a group of people come in and complain about the tennis. A whole group of them, nonstop, complaining about the fact that it's hard to get on the tennis courts early in the morning or in the evening.
And
it's fine during the day.
Group?
Yes, and they all had the same exact.
Who organized the group?
Tennis players.
Probably your wife. No,
she doesn't.
She's a big organizer.
She does not play tennis. She doesn't play tennis.
But she's a big organizer. Tennis. She might have done it just.
She may be a big organizer, but not a big tennis player.
Right.
Not Fair a big enough. Tennis player. We were talking about the presidential elections, and
yes, we were.
And so here we have I just did the numbers. I just crunched some numbers because it's a number-oriented show. Did you know that the two of them? I didn't realize it was this close. That the age difference between the two of these people is 3.5 years. That's all. Yeah. 3.5 years. So literally we have practically an octogenarian election. How and that is there a Trump and Biden trade going on right now?
Yeah, there is. And in fact, if you see headlines like this, I urge you to tune them out immediately. This one says, "I'm a financial advisor. 4 moves I'll make if I think Trump will win the election." Right? And this is the
wait a minute. You won't know until election day, right?
But you're going to be out ahead of this because you're going to know.
We're going to be ahead of this. Uh-huh.
Let's see. Here's a good one. He says target stocks benefiting from tax cuts.
What are those?
I love that one.
H&R Block?
Real estate, because Trump's big in it's Trump's own playground, he says. This is real estate.
Okay,
invest in that.
So Trump is going to be going to be able to turn around the horrible office space market. He's just going to buy it all.
Go back to work.
Yeah,
you're going to get back to work.
Go back to work, darn you.
Get in that office. Anyway, ignore that kind of stuff.
All right, ignore that stuff, and we're going to talk a little bit more about some of this kind of stuff in a minute. And you're welcome to call us anytime at 855-935-TALK because, we talk real money.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
This time of year, every 4 years, the crazies come out of the woodwork with presidential investing advice, as Tom just illustrated. When the reality isn't, and this is what you need to focus on. You're going to read articles. If you read, of course, maybe some of you don't read. You might hear them on the radio. I don't know, maybe even on television. You might hear people saying, well, if so-and-so gets elected. And by the way, just personal note, I'm so unhappy with all of our choices, all three of them.
Oh, that's right. There are three. I keep forgetting that. Yes. Voices from the past. Back to the future.
What is wrong, ladies and gentlemen?
We don't have that much time.
What is wrong with America? Why can't we get somebody?
The octotocracy, is that what they call it?
That's a good one. Did you just come up with that one?
No, I did not.
The octotocracy. Yeah, that's kind of what it is. I mean, 78 and 81 will be their ages on Election Day. 78 and
how old is
81.
Mr. Kennedy? He's early 70s, mid 70s. He's no young guy.
Is he an old guy too?
I think he's. Let's see. I could probably figure it out.
No. Hold on. Robert.
I'm going to say 76. This is a
I just looked up.
Guess.
I just said Kennedy age, and it gave me JFK at 46, and I went, well, no, okay,
a while ago, yeah,
permanently stuck at 46. Yeah. Oh, Robert Jr.
Kennedy Jr. 76. I'm going to predict.
All right, I'm going to see how. Oh, you're off. You're off by about
how far?
Almost 10%. He's 70. He's a
young guy.
He's really.
But he doesn't meet the criteria. The Don McDonald.
No, the under
test.
70.
Sorry.
The under 70.
Sorry about that, sir.
What is it?
The records, and you don't make.
Anyway,
it.
I'm not happy about that. But the point I was getting. I'm
always happy for that. Yeah.
The markets, particularly the stock market, does not react to most news. People think just like you do about the future. And lots of people, all thinking the same thoughts about the future, move the markets in advance of the event. The only time you're going to get a huge impact from an event is when the event is unexpected.
Yeah, and I'll give you an example of this.
I mean, the boat crashing into the bridge. No one expected that.
Yeah, buy some infrastructure stocks. No, but November of 2016, because I remember this clear as day, because for a while it looked like Hillary Clinton was going to be elected, and all of a sudden it turned, right, upper Midwest, et cetera, and Mr. Trump, and the market declined by 800 points, literally, the futures, literally within minutes. And I remember sitting there thinking, I'm going to have to get on the phone tomorrow.
Now it's reacting.
And then overnight it turned and went back up. So they're like, well, wait, Trump's going to be business friend. You are not going to profit from that unless you're really, really quick.
You can't because there are too many people playing with too much money for you to beat them. Now, I looked up Robert F. Kennedy Jr. on Google, and I got to tell you, there are two presidential candidates, though, that are in really good physical shape. RFK Jr.'s in. Look at that guy.
But his voice sounds like something's wrong.
You don't want to see Trump shirtless like this. There's a shirtless picture of RFK Jr., and I guarantee you.
Finally, somebody can match up with Vladimir Putin, I guess.
We got our Vlad. Look at that guy. That is just making me look like a big old fat guy. All right. Well, anyway, thank you so much.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Apella Wealth, a fee-only registered investment advisor. Please see Apella Wealth's ADV Part 2A on our website for information regarding Apella's fees and services. Apella Capital, LLC, DBA Apella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Apella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.